FutureDad 64, How to Become Financially Free, Part 2. Quote, the three most harmful addictions are heroin, carbohydrates, and a monthly salary. Nassim Nicholas Taleb. In the first essay, FutureDad 28, How to Become Financially Free, Part 1, I outlined the necessary mindset you need to become financially free. It's not required reading before this one, but I do advise it. In this sequel, I shall outline the practical steps to attain financial freedom. Note, I will offer no instruction or guidance on which specific securities, for example stocks, funds, crypto, whatever, to buy. That requires knowledge of your personal situation, and also it's not required for this exercise. Instead, I shall describe the straightforward techniques which help me to become financially free, and that's it. 1. Introduction. 2. What is financial freedom? 3. Expenses, the bath plug. 4. Portfolio size. 5. Investment priority. 6. Investment allocation. 7. Selecting assets. 8. Action. 9. Conclusion. 1. Introduction. My first and only interaction with a financial advisor prompted me to take definitive action on my finances, but only many years later, and not in the manner he wanted, buying his services. After a career in finance, I've concluded that with a proper approach, you do not need a financial advisor, merely common sense techniques and good habits. Most people fail to secure their financial future not because the absence of expert financial advice, but rather the absence of good habits. Good habits led me eventually to this point, whereupon I am financially free many years before normal retirement age. I didn't inherit or win any money. I didn't make a killing on property. I didn't make stellar crypto trades or sell a popular app. My background is unremarkable. Several years of study followed by several years of employment. When I noticed the West was going to collapse, I realized I needed to become sovereign, one element of which is financial freedom. Nonetheless, whichever state you're at in life, you must want financial freedom enough to attain it. That means you already feel the pain of not being financially free, and it exceeds the inconvenience of taking action. Are you at that stage? If not, stop watching. Come back to this later when you're ready. Casual curiosity isn't enough. I'm not interested in passengers. I've given this essay as a seminar to a large group of people. Everyone found it interesting, but very few took meaningful action afterwards. Don't be one of those people. So, I want you to ask, am I broke? If yes, then ask yourself, how do I know? 5 ways of knowing. 1. You were off work due to sickness or injury and the bills mounted up. 2. You have persistent credit card balance from one month to the next. 3. You allocate no funds to a pension beyond the mandatory minimum level. 4. You shop out of boredom and worry about the consequences later. 5. You presume the state pension or someone else will look after you later in life. There are numerous other examples, any of which could be crucial to you personally. Each could wake you up to realize you're at a crossroads. Now is the moment to decide. Life needn't be jam-packed with worry. Fortunately, there exists techniques to set you free. They are straightforward, but it's not easy. There is no charge. I merely wish to assist those prepared to learn and take ownership. Still with me? Good. Let's get started. 2. What is financial freedom? What is financial freedom? It is when the choice of what to do with your time is always entirely your own. I will repeat that because it's so important. Financial freedom is when the choice of what you do with your time isn't always entirely your own. Note the absence of any monetary value. It's all about choice and time. You can spend the time playing piano, making workout videos, building a treehouse for your grandkids. It's up to you and not your boss. You may find, like me, it's more gratifying to do productive, creative things with your time, including writing essays and making videos like this one. 3. Expenses, the bath plug. Okay, the hard stuff first. This section is all about your mindset. We begin with expenses because the bath plug requires urgent attention before we consider the taps. There is a simple calculus that I want you to consider, to do with your desires. Does your desire to buy cars, handbags, jewellery, trainers, restaurant meals and lavish holidays eclipse your desire to be financially free? If so, you're a whim-driven consumer, and this needs to change. Recall when you last received a pay rise. You became accustomed to it 2 months later. It became the new normal, and your spending rose to meet it. This is a hedonic treadmill. In the journey to be financially free, lifestyle, also known as expenses, is more important than investment income. Hot tip: next time, don't pay yourself an increase in pay. Pay it to your future self by diverting it to monthly investment. You may already have a hyperbolic time preference. By that I mean that you must have the shiny thing right now, even though what you already have is enough. You are compelled to consume, and you always find the money for purchases you want. Have you thought about why that is? It will help to read my essay on minimalism. Take what you can from it that differentiate between want and need as an ingrained habit. That will help to determine what you really need to live on contentedly. That figure represents your expenses in the calculation below. It is the number after having paid all debts and controlled your expenses in accordance with a non-consumerist lifestyle. Write it down. Once you get to a number, say £1,000 a month, £1,500 a month, or £3,500 a month, or in dollars. I hope not. Whatever it is, then we will calculate what you need to fund it. This gives you how much you will need on Financial Freedom Day, which could be in 5 years or 35. The time frame depends on your consumption habits and desire to change. 4. Portfolio size. From now until your FFD, you'll be single-minded in building your wealth portfolio. Now we must determine its size. The inputs are your expenses, your monthly, non-consumerist cost of living, portfolio return, which is the future income your portfolio will generate, usually via dividends, your personal inflation, and your dividend income tax. You already possess your expenses figure. You wrote that down. We will look at investment return and tax, but first the thorny topic of inflation. Inflation. There are 2 phases to consider, pre and post FFD. Pre-FFD. You need to adjust your current expenses by the inflationary effect on your expenses compounded by the number of years until FFD. So if FFD is 15 years away, your personal inflation is 4%, and today's non-consumerist yearly expenses estimate is 20k, then you need to use 20k times 1.04 times to the power of 15 equals 36k in the calculation below. I'll put on screen. 2 available online personal inflation calculators are Trueflation and FT, but this is up to you. Post FFD, the inflation you face is the rise in your expenses. Inflation erodes the ability of your dividend return each year to meet those expenses. Return. You need to generate income, so the return is effectively a yield, i.e. dividends and other disbursements. For security yields which are too high, above 15%, this is unsustainable, the business industry is in decline, or it's unstable. Too low, below 5%, you may as well invest in premium bonds, bond funds, or cash. This is a function of your risk appetite. The higher, the more risky. The long-term total return of a basket of equities ranges between 7 to 15%, depending on one's assumptions, regions, and timing. This total return includes price growth and dividend. What matters is that you select based on sustainable dividend yield. I personally use some covered call strategies, for example QYLD, RYLD, not a recommendation, to achieve 10 to 15% yield and put the rest in a mixture of moderate yielding, 6 to 10%, securities and funds. The lowest yielding asset in my portfolio is 4.25%, which is a fixed term cash component. I talk a little more on this in section 7.3. 4.3. Tax. I can't do this bit for you. I'm not a tax advisor. I don't know your personal circumstances. For illustration, I shall use the UK tax dividend of 8.75 on income below 50k. I ignore the tax-free and personal allowance part because the former is small and they both may disappear or you have other income. When it comes to financial projections, worst case scenarios are better. 4.4. Number of years. This is years from FFD until death. It is assumed 50 for illustration. 4.5. Calculating the portfolio size. So let's look at some examples of portfolio size calculation. Let's imagine we have £733 5 per month expenses. The return post FFD, it should mostly be dividend on investments, is 7%. Your personal inflation is 4% and tax is 8.75%. You need a £250,000 portfolio on FFD to fund expenses for 50 years without starting to dig into your principal saved. That way, when you die, you can leave your portfolio, likely a much bigger size, to your children. The FX function bar shows the calculation used in the yellow box. The calculation adapts a present value formula for growing annuity, GA, below, verified with an online calculator. The basic idea is that you want your portfolio income to match the discounted present value of a finite stream of growing cash flows, the expenses in this case. Using the sample inputs, as shown on screen, 12 times monthly expenses times 1 over tax return inflation growth times 1 over 1 plus inflation growth over 1 plus tax return to the power years gives a portfolio size of £250,000. What size portfolio for the same parameters except a higher inflation of 5%? £305,000. What size portfolio for the same parameters except a 1/3 higher expenses of £1,000 per month? Portfolio size 341k. What size portfolio for the same parameters except a lower return of 6%? 301,452. Notice how sensitive the portfolio size is to inflation of your expenses. Overall, when you increase the expenses, increase your personal inflation, or decrease your return, then you require a bigger portfolio. When you decrease your expenses, or decrease your personal inflation, or increase your return yield, then you will require a smaller portfolio. If a £250,000 portfolio is required to fund a £733 per month expenses, to get 4 times that, i.e. £2,932 a month lifestyle, you'll need approximately £1 million invested in a portfolio of productive, i.e. income generating assets. At this point you might be thinking, 1 million? The guy must be dreaming. Well, stay with me. It should reinforce the importance upon you of a less consumerist lifestyle. If you have 30k student debt, 10k credit cards, 40k car loan and 75k savings, then you are broke. It doesn't matter how nice your car is, you're still broke. Your spending habits must change. Accept it. Now start at t = 0. If you invest diligently, you can still grow the portfolio you need. It is attainable over the years and decades, as we shall see next. 4.6. The magic of compounding. Einstein reportedly described it as the greatest invention of all time. The magic of compounding means earning interest on your interest, or dividend on your dividend. It takes a while to get going. The best time to start was 20 years ago. The second best time was 10 years ago. The third best time is now. As you see, for someone starting at 25 with small regular investments, after 40 years, the portfolio size reached 470k. That's the purple line. The portfolio size is unimportant. Pay attention to the trajectory. Observe that half the increase was gained in the last 12 years, owing to the earlier compounding. That dividend and interest in the early days were themselves eventually earning dividends and interest. In short, start now. So now you've got to build your portfolio. You must first optimize your pre-FFD investment priorities. 5. Investment priority. Here's a recommended order of priority for investments, savings. 5.1. Debt. Accelerate the payment of credit cards, 18 to 30%. Car loans, 8 to 20%. Mortgage, 4 to 10%. In order of highest debt interest to lowest. You will rarely earn a consistently higher investment income than the interest rate, and especially not without considerable risk. I advise accelerating the mortgage repayments, even when at 4 or 5%, as this instills discipline and prevents unjustified discretionary spending. Pension 401k. Next, invest the maximum you can into a private work pension, assuming you plan to retire at 57 or later in the UK. If before, invest proportionally more into the ISA broker account. Why? A matching scheme is free money and is paid out of gross salary, thereby shielding you from tax up to the annual and lifetime allowance. 5.3. ISAs, IRAs. ISAs are shielded from capital appreciation and income tax, but limited to 20k per annum. The investment derives from net salary, so is inferior, all else being equal, to a workplace private pension. This and the direct investment priority may increase if your FFD is considerably earlier than at 57 years old. Direct investment. Purchasing assets, typically through a brokerage account such as Interactive Broker or Saxo. These are examples, not recommendations. Investing in shares, funds, property, businesses, etc. out of net salary. Any subsequent realised gains or dividend income are subject to tax, so this has the lowest priority. 6. Investment allocation. When still in the accumulation phase, pre-FFD, vehicle and asset class allocation is 6.1. First step. Select the investment vehicle if funds. This should be accumulation funds, AC, not income funds, INC. Accumulation will automatically reinvest back into the fund, whereas income funds may trigger a tax event. 6.2. Second step. Asset class allocation. The tried and tested rule of thumb is to invest approximately your age in bonds, plus 5% cash and the rest in equity. So at 20, allocation is 20% bonds, 75% equity, 5% cash. This is now seen as a bit outdated. Whatever you go with, it is sensible to allocate 5 to 15% in alt, i.e. alternate assets like private assets, real estate, infrastructure funds, fine art and crypto, rather than bonds. These assets have a lower correlation with the rest of your portfolio and thus dampen overall portfolio volatility, which is risk. Beyond that, you will need to perform Markowitz risk-based portfolio construction, which is beyond the scope of this essay. Just keep things simple for now. Equities over the long run generate 7 to 12% return, bonds 3 to 6%, cash 1 to 3%. These ranges hinge more on timing if you buy a small number of assets, so don't do that. Rely instead on diversification as per the next section. 7. Security selection. 7.1. Accumulation phase, pre-FFD, a diversified mix of moderate to high risk securities. What is risk? Imagine a man jumping off one tower of the Petronas Towers in Kuala Lumpur without a parachute, and another man jumping off the other tower with a parachute. Which is riskier? You'd probably say the former is riskier, but the former will likely have a small range of outcomes, with one outcome almost certain: death. There is a low variability of outcomes. This is actually low risk in investment terms. Investment risk or volatility is simply variability of returns in your investments. Why not simply find a moderately risky stock, say Apple or Legal & General or Toyota, and invest everything in it? That would be ill-advised and more akin to gambling. As per the shape of the risk reduction in the chart, a portfolio typically requires at least 40 to 50 securities with minimal overlapping characteristics like country and sector to achieve maximal long-term return per unit risk. So therefore you have to spread the risk by investing in an even mix of different regions, sectors, industries, large, mid and small cap, growth and income, emerging and developed, defensive and cyclic, and currencies. 7.2. Sector rotation. An advanced strategy is to rotate between sectors, i.e. to switch in and out depending on the phase of the business cycle. An example is to choose defensive stocks, consumer staples like food and energy, in the lead up to recession, and aggressive stocks, consumer discretionary like luxury brands, in the lead up to economic recovery. This is difficult to do consistently well, net of transaction costs. It is time in the market, not market timing, that will grow your wealth. Post-FFD phase. By FFD, you should switch your portfolio into low to moderate risk, productive, income-bearing securities to meet your expenses. This includes equities, funds, money market instruments, property, businesses, but excludes crypto, growth stocks, or current account cash as they generate low to no income. Furthermore, a substantial proportion, depending on risk appetite, will be in low-risk assets such as annuities, money market funds, premium bonds, and high-interest accounts. This overall determines the return yield figure used in calculating portfolio size. That's why it can't be as high as you like. Our portfolio return yield of greater than about 12% is infeasible for low to moderate risk. Question: why can't you just sell assets to provide income? Answer: it A, generates unnecessary tax exposure. Capital gains tax is often higher than income dividend tax and usually has no tax-free allowance. B, it is inconvenient. You will have to go to the market and sell your assets, incurring transaction fees and broker costs. C, eats into your portfolio and therefore future income. 8. Action. Here is an overview of the sequence of steps you must take to attain financial freedom. 8.1. Pay down all debt in an accelerated pace. 8.2. Minimize expenses to the bone. 8.3. Decide on the expenses figure you need after FFD. 8.4. Calculate your portfolio target size. That's your pre-FFD goal. 8.5. Select the appropriate investment vehicle. 8.6. Invest in the asset mix as per your age and risk appetite. 8.7. Keep going until you reach FFD. 8.8. On FFD, tell your manager you're not coming in today because you feel well. 9. Conclusion. The road to financial freedom is long, really long. If any of it is painful, so be it. No excuses. Don't will yourself to reach it. Will is weak. Build unbreakable habits instead. You will need to be patient. It will take much longer than you think. You will need to plan. You will need to sacrifice. The rewards are difficult to express, other than to say there are 2 stages in life, before and after financial freedom. FutureDad.